Welcome to Electrified. It's your host, Dylan Loomis. Don't worry, in this episode, we're not going to get super granular as I personally don't put a whole lot of stock in quarter-over-quarter changes, but of course, it's exciting to watch the trends. More importantly though, we'll cover some higher level themes and some trends that are worth monitoring. I'll also give you a rough idea of what I'm expecting for Tesla stock to close the year and heading into 2021, but as always, I'm not your financial advisor. However, I will give you some insight as to why I like revenue multiple valuation more than others. Alright, so taking a look at this chart, the left-hand side is pretty straightforward. The only row needing explanation is ARWOC, which is auto revenue without credits. This row can be thought of as the average selling price for Tesla over the past 4 quarters. It's simply auto revenue without credits divided by deliveries. Q4 2020 is orange as these will be our estimates. One theme I would like to point out here is the percentage of production versus delivered row. As you can see from Q4 2019 up to this most recent quarter, the percentage has oscillated from being over 100% to under. This is pretty simple to understand though. If you look at Q3 2020, Tesla delivered about 6,000 less cars than they produced, which means those 6,000 cars will hit the delivery line in Q4 2020. We saw this play out in Q2 2020 as they delivered 110% of production, and part of that excess came from the roughly 14,000 production surplus from Q1 of 2020. Most of these variances have to do with shipping cars globally, but as Tesla continues to localize production and thus reduces shipping times, these swings should continue to decrease. Now, to figure out auto revenue for Q4 2020, I assumed a slight decline in ASP to 51,000 and multiplied by a 205,000 car delivery figure. As mentioned, I don't want to get super detailed here, but as we've seen with data out of Giga Shanghai recently, Tesla has at times already operated above their stated Q3 production capacity of 840,000 vehicles per year. This is 210,000 units produced per quarter at max capacity, so 200,000 units produced is actually well within reason if things go well. And of course, we have the roughly 5,500 extra cars produced from Q3 that will be delivered in Q4, which could get us to roughly 205,000 deliveries for Q4. This is obviously a massive number and definitely on the optimistic side, but I also believe it's 100% in the realm of possibilities. So with that, Tesla's auto revenue without credits would be about $10.1 billion, and then we can guesstimate about 328 of regulatory credits for Q4 to stay in line with the amounts Tesla has chosen to recognize so far this year. If you take a look at the regulatory credits chart, you can see that without any regulatory credit sales in Q4, they have already doubled up on their credit sales from 2019, which Tesla did say they expected to double in 2020. But adding in the numbers for Q4 reg credits, this would take us to $10.4 billion in auto revenue for Q4 2020. Now, of course, in addition to this figure, we have revenue from energy generation and storage, and then services and other. Services and other includes non-warranty repairs, sales of used cars, retail merchandise, sales by their acquired subsidiaries to third-party customers, and then vehicle insurance revenue. To keep things simple, we'll combine these two segments, and for the last 4 quarters, we see the line items coming in at $1.1 billion, $857 million, $853 million, and $1 billion. Depending on the resources Tesla has chosen to allocate to the energy business for Q4, with the increased Powerwall 2 demand, we can conservatively expect an additional $1.3 billion here, but I'm a little bit more optimistic, and I could see Tesla hitting $1.5 billion here pretty easily, which would take total Q4 revenue to $11.9 billion. If we add this to our Q3 revenue of $8.7 billion, Q2 of $6 billion, Q1 of $5.9 billion, we would end up with 2020 revenues of $32.5 billion for the year. So who really cares? What does this mean? Why are we doing this? This brings us to the revenue multiples and why I'm a much bigger fan of this than some others. Unlike earnings and book value ratios, which can become negative very easily, revenue multiples are available for any firm of any size. More importantly though, with earnings per share and book value, these are heavily influenced by accounting decisions, depreciation, inventory, research and development costs, etc. So they're much easier to manipulate one way or another. Revenue, on the other hand, can't be manipulated outside of things like cooking the books. Revenue multiples are also not as volatile as earnings multiples, and in my opinion, can be much more reliable to use for valuation. The main disadvantage of focusing on revenue revenue is that it can drive you into assigning higher values to firms that are generating high revenue growth, but simultaneously losing a lot of money. Obviously, a company has to generate earnings and profit and cash flow to have any real value, but I already know with Tesla, they are now able to fundamentally turn a profit. It's now just a lever of how much they want to show on the bottom line versus continuing a rapid expansion. So there are two basic revenue multiples to use. The first and most popular one is the multiple of the market value of the stock compared to the revenue of the company. This is called the price to sales ratio, which is just the market value of the stock divided by the company revenue. There is another more involved ratio called the enterprise value to sales ratio. I won't go too far with this, but it divides the total value of the company by the revenues generated by that company, making it more internally consistent. The price to sales ratio divides the stock value by the revenues generated. Just remember this, with revenue multiples, there are less issues with uniformity when comparing this multiple between companies. Accounting standards, even across different sectors, are pretty straightforward when it comes to how revenues are recorded. Now, technically, the calculation would be the current market cap divided by the trailing 12 months, which is TTM. But once again, to keep it simple, here's where Tesla is now. Their projected price to sales ratio with our Q4 estimate would be their latest market cap of $464 billion divided by their estimated 2020 revenue of $32.5 billion for a price to sales ratio of 14.2. This basically means investors are willing to pay $14.20 for every $1 of Tesla sales. A more accurate technical way to calculate would be taking the market cap at the end of Q4 2020 and then dividing by the revenue for the full year 2020 so that the numerator and denominator cover the same time frame. Now, historically, Tesla stock has seen price to sales ratios of 20 and above, even though 14.2 may feel high if this is your first time hearing about this ratio. For some context, Apple's price to sales ratio has been around 8 this year, while Amazon's has hovered around 5. But as you should know by now, Tesla is in a league of their own for many different reasons, so comparing one valuation metric to any other company is kind of foolish. But what's really great about tracking trends like this over time is you can value Tesla against itself to potentially give yourself an edge when it comes to timing your investments. Most of you know I would just advise dollar cost averaging into Tesla for the long term, but for those of you who like to take more control, if you watch this metric and see that Tesla's price to sales ratio dips down to 10 or something even lower, it may be a good time to add more shares. This despite what the raw stock price may be sitting at. As we've learned, revenue is a great simple indication of overall company growth and scale without being clouded by accounting decisions and reporting standards. So now for what you've all been waiting for, my guesstimates for Tesla stock over the next few weeks. I don't like doing this as I know how the internet works, but I will say this. I won't be surprised if we see a Tesla stock price of $600 per share sometime in Q1 2021, if not before. If we take our estimated $32.5 billion in revenue for 2020 and nearly double it to 2021 for about $60 billion for next year based on Elon's growth estimates, and we then use a 15 times price to sales ratio, that would be a $900 billion market cap divided by the 947 million shares outstanding. That would take us to $950 per share for a forward-looking 2021 price target. Of course, to get to $950 per share, it has to start going up eventually, and it really does feel like Q4 2020 and Q1 2021 will be a very strong start down that road. But what do you guys think? Of course, the market is not rational in the short term, especially when it comes to Tesla, but it's always fun to make predictions. So let me know what you guys think below. But that'll do it for today's episode. I hope that you learned something new. If you did, please click the like button. It really helps out. Consider subscribing for more Tesla content, and I look forward to seeing you in the next video. I hope that you have a great day.